Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
We still think that overall, within the AI cycle, we're in probably still the early stages. So the CapEx for those guys, for Microsoft and the other hyperscalers, is probably still going to continue to grow a little bit. Again, demonstrating the continuing investment in AI.
But in the short term, I think it's clear that markets are looking for reasons to kind of fade the trade. And what I mean by a rock and a hard place is that management teams are going to have to walk a very fine line between underscoring their enthusiasm for the AI build-out, as well as making sure that their capital spending plans are rational and shared by investors.
I would say I'm not concerned, but I would like to see the Federal Reserve take some action. They need to send a signal that they're not just concerned with inflation, but they're also concerned about employment and unemployment levels. So I'd like to see them do a 25 basis point cut just to send a signal that they consider jobs to be a priority and that they see this gentle softening that's happening in the labor market right now.
We got 1 hour to go until the market close. So let's take a look at the major averages, Josh. And we've got a very mixed picture today because the Dow is up about 96 points here. The S&P 500 down 0.7%. The Nasdaq down by 1.4%. So not a lot of rhyme or reason there. A lot of divergences within individual stocks. I mean, if you look at the trending list, for example, here today, we've got Nvidia taking a big hit. We're going to talk more about that a little bit later on. CrowdStrike taking a big hit. And then a lot of companies out with earnings. Like PayPal is up by 8%, for example. Merck is down by 9%. After its earnings. Procter & Gamble down after its earnings. So a lot of those earnings moves pushing things around today.
And then the big one after the bell, you can see Microsoft dragging right now. And what's so interesting to me about that one, Julie, is it's really going to speak exactly to one big theme for investors we've been chatting about, which is AI, and maybe some growing skepticism there. AI, spending. We hear about the testing. We hear about the experimenting with companies. But I think investors would like to see more details and data points on actual usage and monetization. You had the Google Cloud giant report, and investors were kind of underwhelmed. Now its rival Microsoft reports after the bell, and you'll see what they have to say. Investors are going to make a beeline for Azure and Copilot to try to get a read on some of those trends. Yeah,
and in a bit of unfortunate timing, Microsoft Azure also had a bit of an outage today, although they said they're resolving that. So showing a lot of red on the board here today. There's one other thing I wanted to mention, sort of away from tech, away from earnings today, and that is in the oil market, because we did get some headlines here that Israel had retaliated, had done what looks like a targeted drone attack within Lebanon, in Beirut specifically. And there have been periods where a headline like that would have caused oil to spike a bit. We did not see that kind of reaction today.
Yeah, so the reports on an airstrike targeting this senior Hezbollah commander, and Israel says he's the commander responsible for the deaths of those 12 kids over the weekend. So, listen, Israel said they would respond, they have, and now you see, if and when Hezbollah reacts and what kind of impact and influence that has on the market.
Right, but right now it doesn't show that there is concern about escalation that would then affect oil supplies.
All right, we'll keep watching.
Yeah.
Moving on, the tech sector weighing on the broader markets as we wait for the onslaught of tech earnings, but that's not the only thing investors are watching. Of course, they're also waiting to see what Federal Reserve Chair Jerome Powell has to say about the path toward cutting interest rates. Our next guest says rate cuts could actually be more of a cause for concern than a cause for joy. Joining us now is Johan Gran, Alliance Investment Management Head, ETF Market Strategist. Johan, good to see you. We want to get your thoughts on the Fed, Johan, but maybe, listen, let's start with the news we're going to get after the bell, because we got big names reporting, Microsoft, Starbucks, AMT, Johan. I'm curious just what you make of what you've heard so far this earnings season, Johan. What have been some of your big takeaways?
Yeah, hey, it's good to see you, Josh. Well, I think the cool thing about this earnings season is the preemptive strikes that it seems to be happening throughout the market. And I know Microsoft has always been, a key component to the Mag 7, if you will, and it continues to be. It's really what you have seen today is some of the chips being taken off the table. And I think that's an indication of what you might want to expect to see in a couple of hours when they actually start reporting. And the bigger news there, I would say, is the ripple effect that it has across other companies, including Nvidia. So clearly taking it on the chin now for a few days here. So I think you're going to see it percolate through. It's all about the expectations. I mean, no doubt these companies have been doing quite well and they have some lofty goals. AI will continue to be a big play. The question is when it's actually going to break through and create some productivity gains more broadly for the rest of the sectors and not just the big IT firms.
Well, and what is your view on that, Johan? Do you think that we are going to see, I mean, by some measures, and it sort of depends on how you slice it and dice it here, but I know some Bank of America data showed that stocks that beat have been outperforming the S&P 500 by a higher margin than they usually do, and even companies that miss aren't necessarily being punished as much. Do you think that people are looking for silver linings here?
So I think that's actually a relatively natural view right now, because you see companies come out and they do the reporting, there is a case to be made for why they should get punished more for missing. You've seen that play out in the European market, for example, much more so this quarter than you have in the United States. But you haven't seen the big key core firms. The tech comes back to the tech firms right now. It's almost all eyes are focused on that. And some of the firms that may have missed their targets to some degree, maybe not have been as punished previously, they might actually take some of that negative spill, if you will, coming on the back end of the reporting that's coming up. Could, of course, swing both ways, but I think it's a little bit of a wait-and-see game this time.
Johan, another theme I want to get your take on, and something we talk a lot about, is the rotation in the market. You had that CPI print, Johan, a few weeks ago, and investors started piling into the small caps. I'm looking at the Russell right now. It's up about 0.1%. I'm just curious, Johan, what you make of that rotation. You think it's real, it's going to stick, or do you think it's a head fake? Curious to get your take.
Well, I think it's a slippery head fake. Maybe I can put it that way, because it's priced in based on the expectation. And I know you wanted to talk about the Fed at some point too. It's priced in based on the expectation of the Fed starting to cut rates in September. So if it's a real rotation trade that you will see leading into these rate cuts, that's a bigger question, I guess. But whether this is going to be sustainable, it's up to Jerome Powell and the rest of the Fed members. The game is entirely focused on the lower expected rates that we are seeing potentially starting already in September.
Johan, do you think that if indeed they're cutting in September, it's not so much because inflation has normalized, although that seems to be part of the equation, but because they are concerned that we're going to see job growth starting to roll over a little bit more?
Yeah, so keep in mind, it's the two things that they've come back to over and over for years now. It's the inflation print, which we've seen coming down, and it's getting mitigated. And I think it's, whether that is due to the restrictive policy from the Fed or if it's just a natural progression as things are normalizing on the back end of the pandemic, that the jury might be out on that particular topic. But yes, as it relates to the confidence from Jerome Powell and the Fed, as it relates to the rest of the economy, that's where you can see like some of those potential cracks, if you will, showing up in the labor market. There's been a few prints now coming out that are pointing to the fact that things are softening off just a little bit. And if the Fed wants to be pricing, if you will, the gap between inflation and their actual rates to make sure that the economy is less restrictive when the turn is taking place, that could be 18 months from now. Nobody knows, right? But that's what they're trying to do. And yes, is the short answer to your question. With the softening in the labor market, yes, that is giving them a great deal of confidence, I would say, to take some of the rate cuts, put them back on the table.
I'm just curious, though, Johan. I mean, traders seem to think that cut in September is basically a lock at this point. If they didn't get that, I'm just curious how you think the markets might react.
Well, I think they will get it because I think that regardless of where the CPI print comes in, it would have to be pretty violently mismatched with expectations for the Fed to change his mind based off of that. And I know you have some labor numbers coming in this week too, and they would also have to be incredibly out of whack, I believe, for the Fed to not actually start cutting. And I say that also based on history that we've seen in terms of how the Fed is acting and how they're taking action. It's been very, very consistent, and you've seen it throughout the season. As you get closer and closer, the combination of the market expectation and where Federal Chairman Jerome Powell is setting the expectation that he will, same thing that we will do tomorrow during his speech, it's always following the same pattern. So it's never a guarantee, but it's pretty close to a guarantee at this point. It's the same playbook that we've seen for a while, except now, of course, we're changing the tune by cutting instead of increasing or holding.
Yep, well, we'll see if he's singing that same tune indeed. Johan, thank you. Appreciate it.
Yeah, you bet. Thank you.
We're just getting started here on Market Domination. Coming up, we'll take a look at what the street's anticipating from tech giant Microsoft's earnings with a preview from Yahoo Finance's Dan Howley. And sticking with big tech, find out which chip maker is best left out of your portfolio in the latest edition of our series Goodbye or Goodbye. Stay tuned. It is yet another big day for tech results on Wall Street. Both Microsoft and AMD, among others, will report results after the market close. Yahoo Finance's Dan Howley joining us now with what to expect from those names. So let us start with Microsoft. A lot of focused on Azure, as we've been talking about.
As always, but now kind of a renewed focus on Azure. It kind of really didn't fall off at all,
Right.
but it's kind of a different focus. So let's just go over the basic numbers that are expected for the quarter. Wall Street's looking at $64.5 billion in revenue, $2.94 earnings per share. That would be better than the prior quarter, where last year, where they reported $2.69 per share and $56.2 billion in revenue. But as you said, kind of the big number is going to be the cloud stuff. So overall cloud revenue is expected to come in at $36.8 billion. Intelligent cloud, which is where they kind of shove Azure into, it's kind of a weird way of doing it. They're like, oh, here's cloud, and then there's other cloud stuff. But anyway, intelligent cloud is supposed to be $28.7 billion. So I think that's all well and good. Looking at the numbers increasing, obviously important. But the one note that I think is going to be worth looking at is where they say AI services contribution to Azure growth. And so they've been discussing that over the past year, or maybe a little more. No, Q4 last year. So they last quarter said that AI services contributed 7 percentage points of growth to Azure. That was up from 6 percentage points in Q2, 3 percentage points in Q1, and then last year, Q4, when they started, it was only 1 percentage point. So they're going to want to kind of see that keep moving higher, just to prove that, look, all this money that we're laying out for AI is paying off. And so, they obviously have a number of AI offerings, whether that's Copilot in Windows or Copilot in Office 365, or their different Azure suites with Copilot. So, they're clearly commercializing this. I think it's just, at this point, it's not so much how do you commercialize it? It's what's the uptake now from consumers, right? Where there's still in some companies the question of how are you going to turn this into an actual product that companies are going to buy. Microsoft's figured that out. Google's figured that out too, and so has Amazon. But Microsoft was really kind of the first to get this going. So now it's kind of the onus is on them to see
how many people want it.
Exactly. Like what companies or do companies want this? And if they're using it, are they sticking with it or are they dropping it?
So that's Microsoft. What about AMD? What are we looking for from Lisa Su?
So AMD, kind of the flip side, not the software, but the hardware. And what folks are looking at for base numbers is $5.7 billion. That would be up from $5.4 billion. Earnings per share of 68 cents. That would be up from 58 cents in the same quarter last year. The data center revenue is really going to be where all the focus is going to be. Obviously, because that's where the CPUs, GPUs are sold, the Instinct GPUs and the CPUs that they have on offer. Looking at $2.75 billion for data center revenue in the quarter, that would be up from $1.3 billion. They have the MI300X line of chips. They've already
rolls right off the tongue when you say that.
Exactly,
Yeah.
so easy. They've already, by the way, announced their lineup. They did this at Computex. Lisa Su came out and basically said, not only do we have the MI300, we're going to be rolling out the MI325 in Q4, the MI350 in 2025, and the MI400 in 2026. So like Nvidia, they give you an idea of what their cadence is going to be and what to expect going forward. The client side, I think, is something that's important to look at as well. That's expected to improve from $998 million to $1.45 billion. Client is where
including
all the PC
chips
sales.
to the PCs. Yeah, got that. How about gaming, Dan? What are you looking for there?
Gaming should get a boost. The expectation is for $1.6 billion. That would be up from the 664 million they saw in the quarter last year. Basically, gaming was torpedoed. It's the same thing with PC sales, right? Everybody went out, bought at the beginning of the pandemic, and then as people started going back out, there was less and less reason. The other thing is you're in a gaming cycle where look, AMD makes the chips for the PlayStation and the Xbox, right? So they make money on these designs. People bought the consoles at the start, right? That's usually what happens. People who are really going to start buying it. They came out in 2020. It's 2024. We're in the middle of it. So, there is a little bit of a downside, but now I think people are starting to pick up. There's going to be some exciting games coming. People are going to want the consoles.
All right, very busy afternoon for Dan Howley.
Yeah.
That's the takeaway. Thank you, Dan. Appreciate it. Microsoft and AMD aren't the only names in tech reporting earnings this week. Investors also have results from ARM, Qualcomm, Meta, and Amazon ahead. AI spend and its impact on company financials could be make or break for some of the street's biggest names, especially in the chip space. And joining us now to discuss is Daniel Newman, the Futurum Group CEO. Daniel, good to see you.
Josh, great for having me. Thanks for having me.
So one thing we were talking about, I'm interested to get your take, Dan, is this kind of this broader theme where investors, at least some investors, seem to be kind of skeptical about AI. In other words, spend, spend, spend. And it is a big expense, but they're kind of looking for like, okay, where's the usage and where's the monetization? And you saw Alphabet get, reported and investors disappointed. Now it's big rival in the cloud, Microsoft reports. How are you thinking about that question?
We are in a blockbuster moment, and not blockbuster in terms of the next big movie, but blockbuster the company, for those of you that remember it out there. If these companies don't go big, if they don't look at this balance sheet and all the cash they have that they're using to do buybacks and they're using to pay dividends, and they don't invest to build out the infrastructure for one of the most important technological shifts that we will ever experience in our lifetimes, they're going to get it wrong. And there are going to be a few companies that maybe listen to Sequoia or they listen to Goldman Sachs reports, the $600 billion AI problem, and they are going to be slow, they're going to wait, they're going to underinvest, and they're going to miss this trend line. Now, having said that, the digestion period is real. The Elon Musk story of, if you believe we're an AI company, invest in us. If you think we're just a car company, we're clearly overpriced. Now, those aren't his words, those are mine. But the point is this is a big moment. CapEx investments need to take place right now. And if they do not make these investments, they are going to miss. And at some point, we're going to be telling the story of Steve Ballmer saying, no one's ever going to do email from a touch screen. It was a big moment in his career. And by the way, Microsoft, the only thing they never got was that mobile device. And it goes back to that moment where they decided that no one was going to use a touchscreen.
What about, it's not just Goldman. I mean, the latest thing to make headlines is this Upwork study showing that people who are using AI at their jobs now do not like it.
Yeah.
They say it's making them less productive. They say it's increasing their burnout. They're not enjoying the experience, it sounds like. Is that just because their companies integrated it too soon before it was ready? Or is that a bigger cause for concern?
Yeah, we have this really important inflection, Julie. We're at this point where people are still a little uncertain what it means. You have all these knowledge workers where work is being done for them. They're a little uncertain what it means for their future, for their jobs. It's all about upskilling and augmenting is kind of the way it's being discussed. But the whisper is, I talk to many of these CEOs, the whisper is there's a lot of prune to grow concerns. We've seen the job counts in the Silicon Valley are back to pre-COVID levels. Effectively, all the hiring that went on has gone away. That didn't happen by accident. These companies, whether it was Musk cutting 80% or other companies much more quietly cutting their staffs, have found out they can be productive. AI is an enabler. It's very deflationary. So people using it, first of all, does it really make it better? Second of all, does the stuff it create really work well? Meaning, how much time do you have to go in and fix it? I think it's early. If you see how fast it's gone from idea to in use, I mean, this isn't quantum. This isn't virtual reality. This has gone very, very quick, and I think there's going to be a lot of real-time adjustments being made.
Let me get your take, Dan, on Nvidia as well. We're down about 6.5%. I don't want to overstate it. I mean, you pull back the chart, what a move. I'm just curious what you think is going on there. I mean, is it getting hit because of the very kind of discussion we're having right now about these kind of broader AI concerns? Is it the report on Apple training its AI systems on Google's custom chips? I mean, I'm just curious to get your take on the move.
If I want to put a real simple wrapper around it, I'd say about 20% of it are the things you just mentioned. It's very specific to Nvidia and some concerns about AI. I think 80% of it is sector rotation. We've seen a lot move into small caps. We're seeing dollars moving into industrials.
So you're saying profit taking?
We're seeing some risk off in terms of big tech, but look at the run it's had. I mean, I think it was something like a 90% annual compound return for like half a decade. I mean, investors have done very, very well. And by the way, if I'm an investor and I'm looking for that moment where I'm going to get back in, I mean, everybody seemed to love it at 140. Now it's lost $1 trillion in market cap. And by the way, nothing in its thesis has changed. You heard every Mag 7 company so far has come out and said, we're spending big on CapEx. And yes, maybe Apple and maybe Google are doing some things on their own, but Nvidia is still a big part of it. The spend is going to be big. The thesis is still very well intact.
And so is that one of your top picks within chips, and what are your other ones?
I think it's become a really nice pick because of the circumstance. I think when it was sitting at over $3 trillion, I was saying maybe it needed to rest a bit. It felt like the run had been there.
It's taking a nap.
It's given a bit of a rest. I really like Qualcomm, and I've talked a lot about this for years. The thesis, it was originally just a handset company, very dependent on Apple. You've seen the company move away from its Apple dependency, yet its IP is so important that Apple can't fully get rid of Qualcomm. But outside of that, this Copilot plus PC, strong commitments from Microsoft. If the AI PC is successful, Qualcomm is going to do well. Of course, they've got their ongoing feud with ARM, but I think that will resolve itself. I also love what it's been able to do in automotive. You've seen it grow almost a $50 billion automotive pipeline. So if you're betting against some of the movements to Tesla and the electric vehicles, we're still going to make smart cars. And these smart cars need these systems, this autonomy, these telematic systems, and Qualcomm's powering that for a lot of the different companies. Beyond that, I'm going to throw an outlier. I like Intel. I don't like Intel at the trading price that some of these other chip stocks are, but look, do you believe we need to manufacture leading edge chips in the US? If you have that long horizon, if you're betting on the fact that the chip making has to return here, and that Nvidia needs competition. We talked about AMD here a little bit. They've got a little bit of competition with its Instinct line. But Intel has to be successful. Actually, for the US, for the country, for the world, we need US manufacturing, Israel, we need Europe, and we need other parts of Asia because we have so much risk in Taiwan right now.
You mentioned ARM too, Dan. I'm just curious to get your thoughts there. We've had CEO Rene Haas on the program, and he's talked about the diversification there. It's not just smartphones anymore, moving to these new profitable areas, data center, PC. What are your thoughts
I'm
there?
glad you asked that. I'll actually talk to Rene this week, and when I speak to Rene, I expect that he's going to continue to double down on how important ARM is in building out all of this AI infrastructure. Of course, everyone talks about the GPU, but there's all kinds of programmable logic, and it's CPU logic. That's where the Grace Hopper, the Nvidia, very well-known supercompute stack that, GPU, CPU. And of course, they've got all these other tailwinds. You got Apple, you got next generation. If this super cycle for phones is a real thing, this super cycle for these other 5G, next generation AI phones, all based on ARM. And then you've got all the rest of the data center build out, lots of ARM, AWS, Microsoft, of course, Amazon, AWS, Microsoft, and Google. They all have a ARM-based CPU in the data center. So a lot of strength for that company. And of course, they've diversified, they've raised prices, they're getting more margin. He's been very confident every time I've talked to him. I expect that to continue.
Dan, thanks for coming in. Good to see you.
Thanks for having me.
All right, let's get to some other trending tickers here on Yahoo Finance today. First up, we got to talk about CrowdStrike and that still declining trend that we've been seeing. It's down another 10% today, still reeling from its massive software update error. Now Delta could be seeking legal recourse. So basically, a source familiar with the lawyer David Boies and that representation confirming to Yahoo that Delta hired his firm to pursue potential claims against CrowdStrike and against Microsoft related to that outage and the effect on Delta's business here. It doesn't seem like there's necessarily been a suit filed yet, but that is a potential outcome here.
You could see the stock just getting slammed in today's trade. It's that headline, and just I think also, Julie, if you're an investor here, you just have a lot of uncertainty. I mean, even bulls on the street are just asking these questions. How are CrowdStrike's customers feeling? What are they doing? Are they pausing spending, slowing spending? Do they expect some kind of pricing concessions because of this? What does CrowdStrike spend actually look like, but both now and ahead, uncertain.
Yeah, Needham becoming the latest firm today to cut its price target on CrowdStrike to $375 from $425, but it's still a buy. And a lot of analysts have said that they're still confident over the longer term, which is quite interesting.
All right, moving to another name here. We're watching shares of Novavax. Check out this one. The stock getting absolutely crushed today after JP Morgan did issue a downgrade, lowering its rating from neutral to underweight, equivalent of a sell. Price target of 8. Novavax shares have been surging up over 250% since May after announcing that strategic partnership with Sanofi. So shares obviously getting hit hard. JP Morgan no longer fans. Analyst says, Julie, the share levels substantially overvalue the potential economic and revenue to Novavax from that collaboration with Sanofi. Sanofi expects the shares to underperform the firm's broader coverage over the midterm.
Yeah, basically Eric Joseph, who's did this downgrade, said, you see this COVID flu vaccine combo that we're talking about here, but he says we see COVID vaccine demand ultimately being fractional to that of the flu, and so that this is just not going to be that additive to Novavax. In addition, he says, looking back again, if you contrast it with flu, COVID-19 was greatly oversupplied, and now it faces a widening demand deficit. So basically, he says Novavax has soared on all these expectations that, in his view, are just not going to be fulfilled.
Yeah, that price target, by the way, the 8 per Bloomberg, street low at this point. All right, coming up in the latest edition of our series Goodbye or Goodbye, we've got a clever way to play the crypto trade and one big chip maker name that's better left behind. That is coming up next on Market Domination.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're looking at the tech players leaning into AI-related innovations. I'm here with Sylvia Jablonski, Defiance ETF CEO and CIO. It's good to see you, Sylvia.
Great to see you, Julie.
So let's get to your buy stock first. That is MicroStrategy. And boy, has that stock had a ride over the last year. We've seen it. Really, it's a Bitcoin proxy, so it tracks pretty closely directly to the price of Bitcoin. So let's talk about why you like it. You say it does participate in AI. So what's the AI tie-in here?
Yeah, so people actually forget that it's not just a crypto company. They actually have business intelligence tools, and so they provide these services that have the premier level of data analytics. So you can do data mining, data visualization. They have bots that allow you to search for information similar to a ChatGPT for different business tools. And I think that they offer one of the more superior products in the industry.
Okay, so not the Bitcoin case for
Yes.
right out of the gate, but it is, of course, a way to play
crypto. It is a Bitcoin
crypto.
case, yes.
Yeah.
It is absolutely a Bitcoin case. And what I like about it is you're straddling both. The hottest trend is AI, and the second hottest trend is crypto. So you're kind of straddling both with this. It's, as you say, a name that tracks crypto pretty well. It's a good proxy for Bitcoin. And so I think investors that want access to that, as well as the AI and innovation, can consider this stock. And it's just another way to play it. So
Yes. And there are an increasing number of ways to play it, but this is still a popular one. And then, of course, there's also the fact that it's sort of integrating blockchain and Bitcoin into the business.
Yes, and so we talk so much about Bitcoin, but I think there was a while there where everything was kind of NFTs and blockchains. We were talking about, this amazing technology that exists. And so they are actually working with blockchain types of technology where you'll be able to identify yourself through a decentralized process instead of a centralized process, which is, kind of the appeal of Bitcoin in the first place. So I think that being a leader in that software development is going to serve them well.
So let's talk about potential risks, as we like to do. The price could go down, and you could see we've seen some of the risks about concerns about ROI on AI.
Yes.
And so I guess those are two of the risks that people look at.
Yeah, and today's a great day to see what happens when you have, a growth tech type, Mag 7 cousin type of stock, right? Crypto's down and all of the tech stocks are down today because of whether it's the threat of the recent strike in Israel, whether it's, thinking that AI is finished. I don't think it's finished. The risk to this, though, is just sort of that if there's this, overzealous belief that AI is over and, investors actually start transitioning fully to small caps, this type of name suffers. If crypto crashes, this type of name suffers.
I want to ask you one more thing. I would be remiss if I didn't ask you about the premium, because people who watch this stock closely have different estimates for the premium at which it trades to Bitcoin, which is big.
Yes.
And so you really, why buy a MicroStrategy instead of buying Bitcoin itself, for example?
I think the performance tells a really good story. And I think that, again, you're getting two trades in one. You're getting AI and you're getting blockchain. And I think that the premium has to do potentially, with some of their involvement in the AI and innovation trade as well.
Okay, so let's get to the stock you do not like as much, and that's Intel. And it's ironic because we were just talking to another guest who did like Intel. Obviously, the stock has really been struggling here.
Yes.
So let's get to why here. The stock is struggling. It hasn't performed well, definitely, as there's been sort of lack of confidence.
Yes, they're a top performer in terms of their worst performance in the S&P 500. So that's not great. I love the stock. It kind of pains me to pick a semiconductor stock to not be so high on. This is very much a short-term type of opinion, but I think their performance is just lackluster. Part of that has to do with recent earnings. Part of that has to do with some of the operational challenges they're having, but they're just not performing well.
Yeah, most definitely not.
Yeah.
And then, that's been borne out then by what we've heard from them earnings-wise.
Yeah, so they've lost, they've lost billions of dollars in their foundry. Sales were down about 31%. They just, haven't hit it out of the park when it comes to earnings and nowhere near there. So I think part of this is also just going to be a restructuring story. And we know that that's the case for Intel. They've been talking about that for the last 2 years or so when they've started to build out these foundries and things like this, but they just kind of need to get it to monetize.
Yeah, well, the question is when, right?
When? And that's the problem, short-term again.
Right, the timeline for this.
Yes, they need to turn this business around quickly. What bothers me a little bit about Intel is every single semiconductor stock almost is or has rallied in the first half of the year. They've certainly had their spots in the market, but just in terms of participating in the demand story for AI and innovation, I just would have liked to have seen more from Intel.
So what could go right for Intel here then?
Yeah.
Oh, we're or we missed our what could go right? But you just tell us.
Yes. So your last guest said it quite well. I think that there is this kind of thought that depending on who comes into office, there will be this push to get everything onshore, U.S. based, U.S. manufacturing. Intel plays there, so I think they win by default. They're the only semiconductor company that really has that type of U.S. presence. Intel is in every single PC out there. Obviously, a well-known company. I think that they just have to fix their operational story, participate better in kind of the supply-demand side of AI for their chips, and they have a shot. So longer term, I actually like the stock.
Gotcha. So this is an
not buying
avoid
it today.
For now.
For now.
Exactly.
Yes.
All right. Thanks, Sylvia.
You're welcome. Thank you.
And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.
Taking a look now at Tesla as it's in the safety spotlight again. The EV giant recalling nearly 2 million vehicles due to a safety risk relating to the car's hoods. Yahoo Finance's Praz Subramanian joins us now with the details. Praz.
Hey Josh, yeah, so about 1.9 million or so vehicles recalled for a safety failure for a hood, unlatched hood. The software was not detecting the hood was unlatched. And with Tesla's, that front hood is actually a trunk or frunk, so people use it a lot. Potentially could come open while you're driving. That's a big safety problem. So they're sending out a software update to fix that. But Tesla fans aren't happy when they call it software update recall, but it really is a recall when you have to be sort of told by the government you have to fix this problem. So that's what's going on with Tesla.
And it's interesting because it sounds like it was more of an issue in other countries,
Yeah.
or at least there have been more reports of incidents related to this in other countries. There have been a handful in the U.S. Speaking of other countries, let's turn to another automaker that is a European one, Stellantis. Apparently it's looking to cut costs.
Yeah, I mean, here in the U.S. actually, because it's the parent company of Dodge and Chrysler and Ram and Jeep. Follows similar moves by GM and Ford, not surprising, but this is the second salaried move buyout offer by Stellantis this year in the last 12 months. We got kind of confirmation that Stellantis did send this email out to the salaried staff. We're not sure how many people this will affect, but the reports the last layoffs or buyouts were pretty severe in terms of the amount of people that were laid off. So this is not exactly great news for a company that's sort of trying to combat inflationary pressures here. I mean, we heard that a lot before, but I got to say the CEO made $40 million last year. So there's a lot of the unions are also kind of fighting back on that too, because there's the whole class structure there is going on.
Yeah, so we'll see what ends up happening. All right, thanks, Praz. Appreciate it. One of today's biggest movers, a company called Commvault, shares of the data backup provider surging after a Q1 beat on earnings and revenue. And joining us now is Sanjay Mirchandani. He is the CEO of Commvault. Sanjay, it's good to see you. So you saw an increase in subscriptions, an increase in demand here that led to this beating of estimates, your forecast also ahead of estimates here. Is it just that people are concerned right now that there are a lot of sort of incoming threats and they feel they need to be prepared?
Well, thanks for having me back. It's a few things. I think we solve a really hard problem for customers, and it's really about resilience. We've moved from protection to resilience, and customers understand that this is a hard problem. They have to pay attention to it, and our platform delivers that across both data centers, the more traditional workloads, and SaaS and cloud-based workloads. So it's all about resilience, and there is a growing attention around that.
Sanjay, you look at the move in your stock, and it's impressive. I mean, up about 90%, Sanjay, in the past 12 months. You do have, competitors, Sanjay, Rubrik, Veeam, Cohesity. I'm just curious when you think about your competitive advantage and just sort of what makes you different, what differentiates you in the market. How would you describe that to investors, Sanjay?
We focus on innovation. That's our calling card. We've spent over $1 billion over the past 10 years on innovation. We do protection. Now we've evolved that to resilience. We have the largest support of workloads for customers. So, we have an internal saying, no workload left behind, because you're only as safe as based on the comprehensiveness of your protection. And so, we have 1,100 patents around the space. And our cyber resilience platform, Commvault Cloud, like I said a little earlier, does both the data center as well as cloud native workloads. We're the only ones who do the breadth of what we do. And more recently, we've also evolved that from data into applications with an acquisition of a company we did about earlier this quarter, Appranix. And what that does is allows you to not only bring the data back, but also allows you to rebuild on-the-fly cloud-native applications. So we continue to expand the capabilities of our platform, and that's how we win.
And Sanjay, I do want to ask you about the CrowdStrike outage. You were asked about it on the call as well, and what kind of conversations you're having around that. Now, in this case, of course, it was an accident, right? It wasn't an attack. But I imagine of what you do, perhaps resilience would be the most relevant to that particular situation. Can you talk to us about maybe what your clients experienced and what you had to step in and do in that situation?
So, CrowdStrike was think of it as a wake-up call. And, this came from, I've been using the term friendly fire. We were, they're a security company. We trust them, and we applied the patch. The actual problem was fairly rudimentary, and the solution also. Had this not been, a patch gone wrong, had it been a malicious actor using a supply chain to get into our environments and do bad things, we would have a real problem. And we'd be still scratching our heads as to what to do, what went wrong, how does it affect our environment. The conversations we've been having with customers have having with us is, had this been malicious, Sanjay, what would we have done? Well, we have over 3,000 customers using a service we provide called Air Gap Protect, which is really an immutable copy of their data in our secure cloud. Had they had that, had they had their Active Directories backed up, chances are we could start bringing them back to life in parallel with trying to do the forensics as to what happened. So this is a wake-up call. It's all about resilience. Usually you think about bad actors. This was well-intentioned gone wrong. So you have to think about that as well. So there's a lot of learning here on resilience.
Sanjay, switching gears a bit here, your business model is in transition to some extent, now with Metallic, a SaaS business. I'm just curious to get your thoughts on that transition, how it's evolving, and how you see it kind of developing from here.
We've been hard at work at this, really moving our business from a perpetual base into a subscription base. And our subscription platform consists of our term licenses and software, as well as our SaaS. All of them, all our KPIs across this grew. Our overall revenue grew for the third quarter in a row. It grew 13%. Our overall ARR grew 17%. Our subscription component of the ARR, grew 27%. SaaS, Metallic, grew 66%, and that's 188 million right now over an $800 million base. So we've really turned the corner on the transition, and our perpetual business is fairly flat, and it's really it's our subscription platform that customers are purchasing.
And Sanjay, I guess some of those numbers tell the story, but obviously you're also a proxy for the appetite for enterprise spending right now. And if I read through your numbers, it seems like that there is that appetite right now, at least for what you do in this resiliency and protection.
We see that. We feel that. The last quarter was testimony to that. Our pipeline reflects it. In fact, in the last quarter, we had a very good contribution for what we call our large deals, which is deals over 100K. It was one of the best quarters we've had with 100K plus deals. So the enterprise is paying attention to the need, which is resilience.
Sanjay, great to have you on the show today. Thank you so much for joining us.
Thanks for having me.
And coming up, taking it to the skies in our investor playbook, we're going to discuss what the latest industry turbulence means for the sector's biggest players. It's coming up next. It has been a turbulent earnings season for airlines. Revenue outlooks have been disappointing so far, and some of the biggest names in the industry still reeling from last week's CrowdStrike outage. But we've seen some positives as well, including JetBlue's second quarter report this morning, which sent that stock soaring. We're looking at how to navigate the big picture with the Yahoo Finance Playbook, and we're joined now by Savi Saith, Managing Director at Raymond James. Savi, it is good to see you. So let's start right there, Savi. JetBlue reports. Investors sure seem like they like what they heard. What did you make of that report, Savi? And just also more broadly, this new CEO's turnaround plan for the airline?
Sure. Thanks for having me, Josh. And it looks like the theme for this earnings season is meeting or beating 2Q and maybe disappointing on the third quarter. But I think with a lot of airlines having reported thus far, a lot of JetBlue's expectations have been reeled in. So I think today kind of met expectations, and we've seen a lot of kind of short squeeze in a lot of these airlines this quarter. Look, we like Joanna's plans here that she has outlined right from the start. We like the urgency. We like kind of going back to the core, and especially on her plan to as a team to address the operations issue that has long dogged JetBlue, and we're seeing some really good traction here very early on. So it's an encouraging plan. Unfortunately, they have this GTF engine issue that's grounding a lot of the aircraft. So there's a lot of noise here, and the earnings is still, negative, and free cash flow is not necessarily going to be on the book for at least through 2025. So still an uphill battle here, but we're encouraged by at least the plan that they have in place.
And what do you want to see from them that would make you more than encouraged, that would make you actually recommend the stock? Would it just be, is it just a matter of executing well on the plan and moving past that engine issue?
Julie, I think it's seeing a little bit more on turning around that earnings. And it's really hard to gauge right now just how much the GTF engine issue is having a drag on their results. And they're making a lot of network changes in going back to their core and seeing more results on that. And if that could really turn things around, and they're hoping for kind of break even next year. If there's any better than that and we can kind of get into the positive territory in 2025, then even with the GTF issue, then that would kind of be very encouraging for the outlook in 26 and beyond.
Savi, I also want to get your thoughts on Delta. I know you like that name, and I'm just curious what kind of financial impact you think this CrowdStrike event had on Delta. Can we try to put some numbers around it, Savi, or is it too early still?
Yeah, we can guess at it. They had about 6,500 cancellations. We think they're going to be fairly generous in taking care of customers. And so we think it's probably around a $350 million impact to pre-tax earnings. And I think if you look at on a worst case scenario, if kind of the Justice Department comes in, if there's fines, and it's probably a $450 million impact. The cancellations were not as bad as what you saw at Southwest in December 2022. So we're thinking that the kind of lower end of the expectation is probably more likely.
And Savi, help us understand, beyond just the direct cost from these cancellations, how flyers react going forward in these kinds of situations. And I think we can look at Southwest as sort of an analogous situation and the issues they had, although this is not as severe as that in terms of the disruptions. Do people, then change their plans if they see the problems that Delta's having? Do they say, I'm not going to book Delta next time, et cetera?
Yeah, I think if you were caught in it and had a very bad experience, the natural knee-jerk reaction is, I'm never going to fly them again. And you saw that with Southwest, but then, a month or two later, you're probably going to fly them because they turn out to be the most convenient or the best price, or it kind of meets something. And I think Delta's historical operational performance probably buys some goodwill. So I don't expect kind of book away to be a long-term event for Delta, although I think it would, do them well to kind of figure out what happened. Was there anything that they could have done better in managing through this? But again, from a passenger standpoint, I suspect loyal customers that are in that mousetrap are there. It will stick with Delta, and those that might have kind of stepped away probably will come back to them within a few months.
And quickly, Savi, just one more ticker. I want your thoughts on Ryanair. It's down about 25% this year, but you have a strong buy on that one, Savi?
Yeah, I mean, Ryanair, it was a bit of a surprise there. The pricing environment that they're seeing is much weaker than we'd have expected, especially given in Europe, the capacity restoration has lagged and still below 2019 levels. But you're seeing some pricing weakness. I think it's the European consumer. Everywhere consumers are getting a bit weaker. U.S. we're coming from a higher bar, I think, a higher level, and so that hit the stock. But at the end of the day, like, Ryanair has a immensely strong balance sheet. They're going to be throwing off a lot of cash over the next few years, especially as they slow their growth. And I think they're in kind of a catbird seat to take advantage of any industry dislocations, or if things do strengthen, then kind of take advantage of that as well.
Savi, good to see you, and thanks a lot for your analysis. Appreciate it.
Thanks for having me.
It's a busy day of earnings after the bell. We'll bring you the latest results from Microsoft, Starbucks, and more. Stay tuned for Market Domination Overtime. That's the closing bell on Wall Street, and now it's market domination overtime. Let's see where the major averages ended the session here today. We're looking at a mixed close here. The Dow finishing higher by almost 206 points, about 0.5%. The S&P down by about the same amount, 0.5%. And the Nasdaq, the big loser on the day, about 1.25%. Of course, we are awaiting numbers from Microsoft and Advanced Micro Devices, among others. And there seemed to be some pessimism that was coming into the tech trade today that really weighed on the Nasdaq in particular. Well, for more on the markets, Josh,
go ahead. I know you were excited. You were excited.
I was excited.
Tomorrow's Fed meeting. Joining us now, Michael Green, Simplify Asset Management Chief Strategist. Michael, great to see you on set.
It's great to see you.
I guess when I read through your notes, Michael, you don't sound
Why
like
do you do that?
It's so quickly, right? You don't sound like a big fan of Jay Powell and the Fed. Not a fanboy. Here you say the Powell Fed has been a series of panics.
It really has.
What do you mean by that, Michael?
Well, in Q4 of 2018, in response to the collateral crisis, so this is very soon after Jay Powell becomes the Fed chair, ultimately takes over the role, we have the collateral crisis. He cuts interest rates despite the fact that we're experiencing very low levels of unemployment, that we've already started to see some acceleration in inflation that had begun at that point. Wages had been rising fairly significantly, and we'd seen this in response to the Trump tax cuts and the stimulus associated with that. So that was a panic in response to the collateral crisis. We then have a very understandable panic associated with COVID, followed by another panic that actually kicks in 2022 when he begins hiking interest rates at a pace that candidly didn't even give the market time to adjust itself, right? So the companies that need to refinance have not actually yet approached their maturity wall or hit the maturity wall where they would experience those higher levels of interest rates. It was just a very deep misunderstanding of the role of interest rates in controlling inflation.
People love to Monday morning quarterback the Fed, right? This is a tried and true pastime here. So I guess this brings us to now and what you think the Fed should be doing going forward.
Well, I think that's what they should be doing, what they should have done. And actually, instead of Monday morning quarterbacking, I actually was out in July of 22 pointing out we'd already broken inflation. And if you pull up monthly inflation numbers, particularly on the PCE side, you discover that this inflation on an elevated, continuous basis above kind of 3% stopped in July of 2022. So everything post the Russian invasion of Ukraine has largely been within the range of historical normalcy. What we have today is we have a situation in which, because very slow-moving components that are mechanically designed to be slow-moving, things like owner's equivalent rent, where you're incorporating a series of 6-month rental pools to capture the data associated with the housing market, because you've actually treated that as effectively that the map becomes the territory, right? The numbers are right, not what we're actually experiencing in the economy. The Fed is way late to this process of cutting interest rates. We're seeing this in terms of rising consumer stress. We're seeing this in rising delinquencies, particularly for those of the lower strata of the income percentiles. And on the flip side of that equation, we're actually seeing households that are older, that have accumulated resources. They're suddenly blessed with an extraordinary amount of interest income that is sustaining everything from cruise lines to happy hour early dinners at Howard Johnson's, which I no longer really exists. So we're actually very much in a situation where the Fed has created an animal that it now needs to figure out how to address as well. My hunch is we're going to see another panic.
So those are your thoughts broadly on the Fed and the economy. But for viewers who are listening, right, Michael, and they're invested in the stock market, what's your advice?
Well, I think that there's two separate components. So one is remember what actually happens in 2022. The Fed begins hiking interest rates. That hits the bond market. That flows through to the stock market, not because people are suddenly doing discounted cash flow analysis and saying, hey, maybe Microsoft is worth less. What it's actually doing is lowering the value of their bond portfolios. Because it lowers the value of their bond portfolios, they then have to sell equities, buy bonds to keep a fixed allocation. This is how things like target date funds work. So we can very clearly see that that's ultimately what played through. The minute we were done with that interest rate hiking cycle, the minute we stopped hitting bond prices, equity prices began to recover. And today we see valuations at the same levels that we saw going into those events. The level of interest rates has had no impact whatsoever. Now the Fed, of course, is turning around and saying, hey, what happens if we begin to cut interest rates? We can't do this, right? Because that'll send asset prices even higher. Well, it didn't affect it on the way up. I think it's unlikely to affect it on the way down. And if anything, those interest rate cuts could very much actually be a trigger for reduced income in that segment of the economy that has continued to spend. And so you just want to be really cautious in thinking that this is ultimately going to be some big asset boom that plays through. We saw the same thing in 2000. We saw the same thing in 2008. By the time the Fed gets to the point where it's aggressively cutting rates, it's probably too late.
Michael, I would love to keep talking, but we got to go because Microsoft is out. But thank you so
There we
much
go.
for coming in. Really
agree.
appreciate it. A really interesting conversation. Let's talk about Microsoft earnings from its fourth quarter, just now crossing the wire, and the stock is already falling here. That's because intelligent cloud revenue. Remember, our Dan Howley really pinpointed that number. Intelligent cloud. That's where the Copilot, is worked in here. That AI-enabled service. $28.52 billion. $28.72 billion is what analysts had been anticipating. Cloud revenue overall about in line with estimates, perhaps slightly short of estimates. And overall revenue of $64.73 billion was above the $64.52 billion estimate. But it seems as though, really, Josh, it appears to be that intelligent cloud. We know there is so much attention around what is AI doing for revenue? What is AI doing for the bottom line? And this seems to be the answer, at least initially, could change, that the market is taking.
Yeah, now importantly, we don't have guidance for Microsoft. We're going to get, usually you would hear Microsoft CFO Amy Hood give that on the conference call, and that can obviously have a big impact on the stock. We'll wait to hear those comments, the colored commentary, and the forecast. But yeah, you're right. I mean, investors, as they kind of think through the AI spend, on Microsoft at least, you do make a beeline for Azure. You make a beeline for Copilot. I'm just looking here from comments from CEO Satya Nadella, trying to put a kind of an optimistic spin on this, saying, listen, talks about strong performance this fiscal year. He talks about how that speaks to their innovation, the trust customers, he says, continue to place in Microsoft. But clearly, at least the initial reaction here, disappointment in the after hours.
Yeah, and in terms of their other business lines, by the way, productivity and business processes and more personal computing, both of those actually beat estimates.
Yep.
Revenue and productivity and business processes was up 11%. More personal computing rose by 14%. And intelligent cloud was up 19%. It just wasn't quite as much as what analysts had been anticipating. We're also, of course, going to dig in and, of course, get more on the call on CapEx and what
that'll
they're
be
spending.
huge because what does CFO Amy Hood tell you about what they're spending now and what they see spending ahead? How is that greeted? When Alphabet gave you those numbers, it was not greeted enthusiastically by investors.
No, and that is coming, by the way, the call that we keep referring to, 5:30 p.m. Eastern, where we're going to get that forecast and more details on these other items. In the meantime, let us also turn to another company reporting earnings. That is Starbucks. Third quarter numbers hitting the wire here and showing bigger declines than estimated in the company's comps, but the shares are actually rising. Let's dig into it here. So third quarter comparable sales overall globally down 3%. 2.7% is what analysts had been anticipating. China comp sales down 14%. 10.6% is a decline is what analysts had been anticipating. And international overall slumped more than had been anticipated. Adjusted earnings per share did beat estimates here at 93 cents, beating by a penny. So unclear exactly what in here investors were happy about or less upset about to send the shares up by 3.5%, at least at first blush here.
Activists also involved in this one. Paul Singer and Elliott Management taking an undisclosed stake. Remember, we heard in the company, that was according to a report in the Journal, and some of the street are already kind of thinking through what changes, if at all, could Mr. Singer and his team there want to see. Investors are kind of taking their best guess. Could it mean they say, invest more in leadership with kind of more operational restaurant experience? Do they want to see a reduction in unit growth? We'll see, but certainly at least the reaction here positive in the after hours.
Yeah, Rachel Ruggeri, the CFO, in the statement talking about efficiency efforts tracking ahead of expectations. She says partially offsetting investments associated with the cautious consumer environment. So maybe cost cutting is something that investors like here. I mean, when it comes to Starbucks, there's one topic and one topic only that we've been talking about in our office, which is that our local Starbucks here in New York City has closed.
Very disappointing to me as a loyal Starbucks fan.
Yes, and you're not the only one.
You well know.
There's a lot of dismay in the office around this, but maybe that's part of the efficiency that they are referring to. I don't know.
I know, and you know I've got an option B, which I won't name on air, which I'm very disappointed on because I'm not.
There are other options.
I know.
We'll
right.
talk
You're right.
off
All
air.
right, let's move to another name. Pinterest. Let's get that. That's out. Let's see the results here. Q2 adjusted EPS, Julie, 29 cents. That is a beat. The street was at closer to 28 cents. I'm looking for Q2 revenue, 853.7 million. Also a beat. The street was at 848.2 million. Let's look ahead now.
Not so good.
Q3 revenue. So the forecast for Q3, they're saying 885 to 900 million. The estimate, to your point, Julie, 907.7 million. That does miss consensus.
Yes, so that is why those shares are down here in the case of Pinterest. Now, Pinterest, year to date, not much changed. It's only up about 1%. So it's not as though it was running up hugely into this report. And that's what's going on here. So interesting to see this negative reaction. You know, Bill Reddy, the CEO, in the statement talking about monetization efforts paying off and advertisers seeing improved performance on Pinterest. They're gaining share of advertising budgets that he talks about, and yet you do see this outlook. So hopefully we'll get some more comment on the call from this one as well.
Remember we had talked, interestingly, this week with RBC's Brad Erickson.
Yes.
And he had done some checks, which, and Brad is obviously, he's a bull on the name, long term, he likes it, but he himself had said it had looked mixed heading into the print.
Maybe traffic
I believe is
had
how
been
he put
trending
it.
downward. I remember he talked about
Yeah, that ad demand, I think he said, looked fairly healthy, but traffic, at least on mobile, again, according to his checks, not so much. So anyway, at least initially, investors very disappointed by the print.
Indeed.
All right, coming up, we'll have AMD results for you next on Market Domination. Starbucks just reporting mixed third quarter results. The coffee giant same-store sales falling 3%. That is slightly worse than expected. Placer AI head of analytical research, RJ Hadavi, joins us now with the reaction to the print. RJ, it's always good to see you. So looking at the stock, it's actually popping about 2% here in the after hours, RJ. But let's start with your response to the print, RJ. What'd you make of it?
Yeah, looking at the numbers, I mean, I think the U.S., I think a lot of investors were bracing for the worst after last quarter in terms of visitation trends. They came in slightly better than at least the consensus numbers that I've seen. Maybe a little bit of relief on that. Still negative, obviously, -6 in terms of comparable transactions. So this company still got some things to work out, but positive sequential momentum and maybe some evidence that some of the things they're working on in terms of new product innovation, in terms of discounting and value, maybe paying off and driving more visits. So initial reaction, still a lot of work to do for the company, but also some progress compared to last quarter.
And what is your data showing you in terms of what are people, how are traffic trends looking at Starbucks and in terms of what people are spending as well?
Yeah, so our data, if we adjust for the 5% new stores that are in the system compared to last year, we're generally showing visitation trends down year over year as well. But the important thing, too, is that one of the things that the company is focused on is bringing back more of the occasional users. And we did start to see a bit of progress on that as the quarter progressed. Some of that lined up with the promotion, some of that lined up with some of the new summer beverages that they launched. We are starting to see a little bit of encouraging that those kind of everyday, kind of occasional users are starting to come back. I wouldn't say it was in droves, but certainly some positive momentum on that. And so the company continues to see more visitors than ever before, just getting frequency, encouraging more frequent visits, which I think a lot of the initiatives that they have, if given time to play out, will start to do that.
RJ, activists are involved in this name. Got Paul Singer involved in his firm. To the extent they have an undisclosed stake per the Journal. I'm just curious to the extent that they want to see changes. You know the company very well, RJ. What kind of changes, if they do press for them, would you think they may emphasize?
Yeah, and Elliot's a smart group too, so I'm sure they've got some big vision for the company here too. My thought is really just kind of getting that occasional user. We've seen Starbucks, a lot more competition from the likes of Dutch Bros, some of the more private coffee chains coming up, even more competition from QSR and other channels as well. How do you get that brand back in focus? How do you bring people back into those stores more frequently too? I think that's kind of the big message. We've seen a lot of changes in consumer behavior. That's what our data shows. A lot more people coming into different day parts, people wanting different things, people wanting new innovation. And I think that Starbucks is starting to act upon that, but maybe not to the same degree that they need here too. So, probably more in terms of innovation. The company talked about efficiency in the press release. Throughput during peak hours has always been an issue here. That's another thing that I think they can work on. Better balance between the in-store experience and the digital mobile ordering app. I think that's certainly something that the company needs to look at. So if I'm going through the checklist of probably what they're looking at, it's probably looking a lot like that.
And it's interesting because when they said efficiency in the release, I think not only of throughput and like getting your coffee when you want your coffee and not encountering the scrum there, but also them saving money. So my question was sort of, how do they, be cost effective while at the same time improving on those things that you're talking about, like innovation and like throughput?
It's a broad-based effort, to be honest, and I think the company has made inroads into some of the things they need to do there. And really, with the company, if you think about it, it was built on the third place experience. It was this place away from home and work, and built on this experience. But over the last decade, obviously, convenience and mobile ordering has come in, and really, the company is trying to serve two different audiences at the same time: the experience customer as well as the mobile ordering customer. And so I think a lot of that efficiency comes down to identifying what store serves what need. And so you might have an experience store, a larger format store, or even one of the roasteries. And across the corner, you may have a smaller format store. And I think some of the things they're doing in terms of mobile only pickup type locations, smaller format, I think you can start to better address consumer need states with the different locations that they have. And when we do see similar locations located nearby, we do, and they clearly have a need state served, we do see some positive or some really encouraging visitation trends when we look at that. So that's one of the things I think they need to address here.
RJ, we talk about Starbucks, obviously the giant. What about its smaller rivals, Dutch Brothers, for example? How are they performing? What are you seeing there?
Yeah, we're seeing some positive traffic trends. And to be honest, Dutch Bros and many of its other competitors, kind of in the drive-through small box coffee space, are generally outperforming the category and outperforming Starbucks at this time. I think some of this has to do with picking the right markets. Dutch Bros is going into markets where we generally see underserved markets, so kind of the Tennessee, Missouri, Oklahoma space, generally underserved in terms of coffee visitation. So I think that they're in the picking the right markets. They're also doing a good job kind of addressing the move away from urban to more suburban and rural locations. I've done a good job with that, but also good job with menu innovation, good job with throughput. They're kind of doing the things that Starbucks needs to look to in terms of just the whole package here: innovation, experience, throughput, doing a lot of things right there. So our data says some pretty encouraging numbers for Dutch Bros and a lot of their competitors.
RJ, thanks a lot. Good to see you.
Absolutely. Thanks.
Let's get to Advanced Micro Devices. Those shares are rising after the company reported results for its second quarter and came out with a forecast that is being read positively as well, up about 3% here. Second quarter adjusted earnings per share beating by a penny at 69 cents. Revenue at $5.8 billion, also beating estimates. And the company now says for the third quarter, its revenue should be $6.4 to $7 billion. The estimate was $6.6 billion there. The company says also for the third quarter, its adjusted gross margin will be 53.5%, which is a little bit lower than estimates, but people looking on the bright side here. In the statement, they talked about the AI business continuing to accelerate and that they're well positioned to deliver strong revenue growth in the second half of the year, led by demand for some of their processors here. So all of this lending to some of the gains that we're seeing in the after hours.
Yeah, just seeing some comments here by CEO Lisa Su, who says they delivered strong revenue and earnings growth in the second quarter, driven by record data center segment revenue. Says their AI business continued accelerating, well positioned, she says, to deliver strong revenue growth in the second half. The rapid advances in generative AI, she goes on to say, are driving demand for more compute in every market, creating significant growth opportunities as we deliver AI solutions across our business.
Yeah, and to your point there, overall revenue was up almost 9%. Data center revenue at $2.83 billion. That's a more than doubling year over year. The estimate there, $2.75 billion. And just like intelligent cloud was the most important thing for Microsoft, data center was the most important thing to watch for AMD. And in this case, they delivered. So it looks like that is what investors are likely zeroing in on here.
Yeah, on the call, lots of questions. I mean, more obviously color and commentary the street's going to be looking for on what Dr. Su has to say about AI chip revenue. Also, though, the overall PC market, how she sees that evolving. As our own Dan Howley's pointed out, the boom during the pandemic, then the slowdown, now signs that it's on the rebound, and gaming as well, what she sees there.
It'll be very interesting tomorrow, kind of which tech narrative takes hold. Obviously, Microsoft is bigger than AMD, and so even though AMD shares may hold up, are we going to see an infection to the rest of the tech space from Microsoft? One other headline I want to mention here that, again, our Dan Howley flagged as an indicator for Microsoft, the company saying AI services contributed 8 points to Azure revenue growth. Now, that's been moving up incrementally.
Yep.
I believe he said it was 7 last time around, had moved up from 6. So it's sort of inching up there. Is that fast enough for what investors want? Who knows? But it looks like that the company is emphasizing that part of the business.
Yeah, again, listen, all eyes are on the call for Microsoft because we don't have a forecast yet, and so there's even more attention paid to what CFO Amy Hood has to say about the quarters ahead. What's interesting now, you've had 2 of the 3 cloud giants report. So we had Google report and disappointed, and now Microsoft reported and underwhelmed, at least initially. So now we wait for the third one, Amazon, see what they have to say.
Yeah, and not to mention we got to wait for Apple too.
Yep.
Even though it's on a cloud giant, obviously what it's going to say about AI going forward. They're
going to try so hard on that call, Julie, to get anything from Tim Cook and Luca Maestri. Because the whole focus, obviously, on the call will be they're going to try to get some color about the next iPhone, which you would expect Mr. Cook to take the stage in September and unveil. And of course, you're right, the bulls were pinning a lot of hope on. Well, it's an AI-enabled iPhone, and it's going to drive this this big upgrade cycle. We'll see what we can get out of Apple on the conference call.
And by the way, just checking on shares of those companies, Amazon is down almost 3% in after-hours trading, most likely because of what we heard from Microsoft. And Apple is down a little bit, just about 0.5%. So when I talk about what's going to be the bigger ripple effect, Nvidia is the only one that's up, but it was down 6% in the regular session today. So should be an interesting day tomorrow.
For sure.
Speaking of tomorrow, it's time for What to Watch.
That's it. That's it. Time now for What to Watch. Wednesday, July 31st. Fed Day is finally here. Wall Street not expecting a rate cut this time around, but we'll be looking for any insight into a potential September cut following the decision. Fed Chair Jerome Powell, of course, will be holding a news conference. Yahoo Finance's coverage of the decision and news conference will start at 2 p.m. Eastern.
Moving over to earnings, it will be another big day of results tomorrow. We'll hear from Meta, Boeing, and Qualcomm. Meta will be the fourth of the Magnificent Seven to report this season, and analysts expect the tech giant's user growth to taper while ad pricing and election ad spending drives sales growth. We'll also be keeping an eye on second quarter earnings from Boeing in the morning.
And finally, pending home sales data for the month of June coming out in the morning. Those are sales in which a contract has been signed, but the transaction has not yet closed. After seeing a 2% decrease in May, economists are forecasting the new print to show a 1.5% increase. On the other side of the break, more coverage of Microsoft's earnings.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Welcome to Asking for a Trend. I'm Josh Lipton. A busy day of earnings after the close today. Let's get into today's trading takeaways with Yahoo Finance's Jared Blickery. Jared.
All right. Well, first of all, we got to start out with Nvidia because it was another big day.
What is going on?
With Nvidia, let's just bring up a chart. And so we're going to move from the sector action. Hold on. Close your eyes. There we go. Right. So here's our Nasdaq 100, and here's Nvidia. You can see it's down 16% in the month of July. And let's just bring up a year-to-date chart because this has been some nasty downside action. Something like $800 billion, $780 billion to be exact, has been erased in market cap in this move. But I want to remind people we had a pretty lengthy consolidation last year, lasted about 6-7 months. So this is not unusual. I think peak to trough here, we're looking at something like, don't quote me now, I don't know, 15, 20%, but it's not a huge, in fact, I think it's bordering on 20%. By the way, never say a stock is in a bear market if it's down 20%. Don't do that for individual stocks.
I've been ripped on social media for doing just that, Jared. Let me ask you, let's look at the technicals. For traders who are watching right now, they want to, where is support, Jared? Where is support?
You know, I got to draw, I'm going to come back down here to a year to date. I'm put candlesticks on. I like the $95 to $100 level. That just takes us clean back to the upper resistance area from this consolidation period that we had earlier in the year. So, I mean, let's get back to the consolidation issue. Nvidia tends to consolidate more than it trends. So this is not in and of itself worrying. However, we dip below 95, it's another ball game because then you're in this prior territory. You start getting into head and shoulders, you know, potential problems there. So I would just keep an eye on this for the time being.
Levels to watch.
All right. Next up, we got to take a look at, I'm on pins and needles here, July. The month of July, it went so fast, but now now it's a wrap. All right, I'm going to go back to my sector action. I want to show you real estate has done the best in July so far. That's on the sector side. You look at the leadership side here, and I look at some of my sentiment indicators. KRE, regional banks. Who would have thought at the beginning of the month that KRE would be up 19%? Let me just touch this here, and I'm going to pull up a chart that goes back to the carnage that we had last year. Remember, it fell off during that internet bank panic, and now it is just about reclaimed all of those losses. So that's kind of what we're dealing with here. You get above, let's say 60, you're in a whole different game, but we're not quite there yet. So that's just regional banks. Home builders up 17%. Small caps, remember that great rotation we've been talking about in small caps. Small caps up 10%. What did not work? Well, tech, XLK down 7%. And you kind of balance this out with the rotation that's going on. It's nice to see financials in there. It's nice to see industrials in the mix. But we're also seeing a bit of defensive action with utilities and real estate there. So all in all, been an interesting month.
Let's spin ahead August. What are we seeing?
August, you know what? Tomorrow is Fed Day. July's not even over. Let's worry about tomorrow first. No, that was kind of a trick question. August, you know, I think we're going to see a little bit more of the same. I think if the bottom falls out with some of these tech earnings, and you know, we just had some this afternoon. If the bottom
Microsoft, the initial reaction not great.
So let me put it this way: what you don't want to see is the contagion in the Mag 7 lead to everything else. So small caps start going down along with the big guys, then you've got a problem. All right.
Finally.
Guess what? VIX. And we're going to do seasonality. We haven't done seasonality in a few days. But the VIX tends to pick up in August. And so let me show you my historical VIX map. Historically, going back to 1990, the purple is what usually happens. And then the cyan is what has happened this year. You can see it's not perfect. It's not all of these peaks precisely line up. But in general, we do have this trough in here. We're seeing a little bit of a pickup. It was a little bit early, but it's really not until August, September, October that we get into primetime crash season. So that's when I'm really more concerned about the VIX picking up here.
What about seasonality for stocks?
Oh, I'm glad you asked because I have a seasonality map for stocks here. This is one I showed. I don't think I've showed this for a couple months, but at the beginning of the year, the first 5-6 months were up a lot. And so when we have those first 5 or 6 months up a lot, what happens for the rest of the year? Well, July still tends to be positive. August still tends to be positive, but not nearly as much. And you notice the percentage positive is trending down. So it's not necessarily that it's a headwind, it's just not the tailwind that it was. And then you take a look at September, October, that's when I get a little bit nervous. That's when the VIX could spike.
All right, Jared Blickery.
All right.
Thank you, brother.
Another day.
Julie, over to you.
Thank you. Well, Microsoft missing on intelligent cloud revenue expectations. That's sending shares of the software giant tumbling. For a closer look on the AI narrative in big tech, let's get to RBC Capital Markets software equity analyst Rishi Jaluria. So Rishi, obviously, we're feeling a little jittery around this whole AI contribution, what it was going to mean for the company. It also looks like they're saying that AI directly contributed to about 8 percentage points to Azure's revenue increase. So what's your takeaway overall, first of all?
Yeah, and look, and thanks so much for having me. I think the biggest takeaway from this is we've seen a little bit of a reversal of the trends that we saw last quarter. Last quarter, we not only saw AI continue to grow, and we see that again this quarter, but we saw the rest of the Azure business, right? Azure X AI, as we think about it, everything else, that also accelerated last quarter, and that decelerated this quarter. And I think that's why the stock is off, 5-6 points right now. Don't get me wrong, 8% growth on 8% of total growth coming from AI is truly an incredible number. Just to put it in perspective, that means AI within the Microsoft bucket is about $6.5 billion of ARR. And by the way, that is using what I think is a conservative definition, where they're not including training of GPT-5 or anything like that. But given the run up the stocks had and the deceleration in Azure, I'm not surprised to see this. To me, it's going to really come down to the guidance on the call. What are they going to guide Azure to going forward? How should we think about total revenue growth? And maybe most importantly, what does that CapEx number look like? Because CapEx grew very rapidly this quarter. I actually think we're going to see a much higher CapEx number in FY25. My numbers are $5 billion above the street. As long as I think they spend wisely and they have precedent for it, investors might be fine with that, but let's watch out for that guidance.
And on that call, Rishi, if you have the chance to ask exec Satya Nadella, Amy Hood some questions, what would be the questions top of mind for you right now?
I think I would have two questions. Number one is last quarter, we did see that Azure XAI accelerate, and we saw that decel this quarter. What's causing that? Is that a function of just maybe intensifying cloud optimization and cloud rationalization headwinds? Is it competitive issues? Is it something else in the market? And then number two, on the AI side, do they continue to be capacity constrained, or are they hitting that equilibrium where they actually have enough capacity to meet demand, and we might hit a peak in CapEx and start to see CapEx as a percentage of revenue taper down from here?
Rishi, what about the interplay between OpenAI and Microsoft at this point? And is there a way to sort of quantify the contribution that is making?
It's really hard. If I were to say what is the biggest contribution of that AI bucket, that $6.5 billion of ARR I talked about, though, it is mostly OpenAI as a customer. A very important distinction there, which I would question how other hyperscalers may be accounting for similar commercial arrangements. Microsoft does not recognize any revenue in that bucket or anywhere on the Microsoft P&L from training of GPT-4, GPT-4.5, GPT-5. So it is purely, OpenAI as a customer of people using ChatGPT. It is companies like Salesforce and ServiceNow and HubSpot using the APIs to build their own generative AI solutions, and it's actual inferencing, but it is not the bulk training of the model, which is actually where all the CapEx is going. So OpenAI is really important as a customer and as a partner.
In terms of the great cloud wars, the cloud giants issue, so we've now heard from two. We've heard from Google, we've heard from Microsoft, of course, Amazon is on deck. So far, what have you learned about the state of play as we are right now?
I think what we're learning is it's very early in AI. CapEx is going to be through the roof because this AI is really, capital intensive. It's totally resource intensive. And there is a little bit of an air pocket behind enterprises having discussions in AI and actually using AI widely within the organization. And at the same time, I do think we are seeing some competitive dynamics where Azure may be potentially gaining share versus the other hyperscale cloud providers. But make no mistake, at the end of the day, we are learning that cloud optimization and cloud rationalization are not over, even though we've been talking about it for 2 years. And it may ultimately be up to AI to save the day.
Rishi, what's the read-through for other software companies in your universe? I mean, obviously, Microsoft is sort of in a different phase of its AI journey than some of the others, but, are there implications?
I think there absolutely are. I think the major implications for me is that macro environment for software is really tough right now. I know we saw some signs of green shoot, and there were maybe some signs of optimism from the investment community that we might see some stabilization, especially after, I would say decent earnings reports from companies like ServiceNow, Pegasystems, et cetera. But the fact of the matter is it is still a very tough macro environment for software companies out there. And I don't think we're going to get out of this macro malaise this year. It might be next year. It might be, until the AI tailwinds kick in. I don't know when that's going to be, but we might be in a new normal when it comes to software spending and never going back to the 2020, 2021 days.
Rishi and Julie, thank you both so much for joining the show today. Appreciate it.
Thank you.
Coming up, AI chatter is once again dominating earnings, but when will it appear in the workplace? We'll take a look at how companies are preparing employees for the new tech next. We're asking for a trend right on the other side. For workers looking to advance their careers, a tighter job market has made accessing external options tougher. One solution for those looking to climb the corporate ladder, upskilling. And one company, Guild, wants to help. The platform allows companies to provide employees access to a range of education and skilling courses to expand their skill set. Joining me now to discuss is Bijal Shah, CEO of Guild. Bijal, it is good to see you. Maybe to start, Bijal, just for viewers who might not be familiar, just describe the mission of the company for us. What's the problem you're trying to solve for?
Yeah, our goal is to help employers find and unlock opportunity for their employees. And what that means at the end of the day is, as they think about their future of work strategies, ensuring that they're providing their employee population with the skilling, either reskilling or upskilling that is needed to prepare their future workforce.
And so let's do a real world example, Bijal. Let's say, I'm a cashier. There's a group of folks who've been impacted by technology, right? And they come to you. What exactly do you do next? Is it coursework?
Yeah, so we curate a marketplace of offerings for that employer partner, and we provide the employee with access to that curated marketplace of either finishing their high school diploma, getting a certification, being able to actually get a bachelor's or a master's degree. We provide a full spectrum of options that enable them to move in their existing job or get better trained in their existing job, or to actually find new skills that will help them move laterally to other parts of the organization.
And is there a typical person who comes to you all, Bijal, Gil? I mean, is there a specific demo in terms of men, women, young, old?
So we predominantly serve frontline employee populations. Those happen to be workers that are working adult learners who are looking to further gain skills and to educate themselves. However, our platform is a broad access platform, so it works for the entire workforce, just given the spectrum of types of offerings we have inside of our marketplace.
And how many people, Bijal, have you all served to date? I mean, how big is this market?
The market is huge. We work with a ton of employer partners across the United States who have upskilling and reskilling needs. And when you look at the jobs data or you look at the future of work data as it relates to AI, the need to continue to evolve how the workforce works and who gets involved in the workforce and how they're skilled and educated is going to continue to change. And so think of every large employer inside the United States, or frankly, every employer. The need is quite vast. And with advancements in AI, this is just rapidly evolving.
And you mentioned AI, Bijal. It is rapidly evolving. It's a new technology. I'm just curious how you're thinking about it, how you're addressing it.
Yeah, we do a ton of great work with large employers in terms of helping their employees get the practical skills and knowledge that they need to utilize AI on the job. And so we offer an AI skilling bundle that allows frontline workers to understand how AI might work in their job. It allows corporate workers to understand, what are the puts and takes of AI? What are the ethics behind AI? How should they be thinking about utilizing it? And we also allow leaders to participate in programming that helps them understand how will the role of a leader evolve as they continue to make investments in AI.
And Bijal, I'm just curious how you measure success at the company. What are the metrics you're watching? Is it how many people you're able to kind of move up to the job they're looking for?
Yeah, so our goal is to unlock opportunity for America's workforce. And when we say opportunity, we mean ensuring that over the course of someone's career, they have the ability to reach sustained economic well-being. And so when we think about how we measure success, we think about it in three different ways. The first is, what are we doing to drive an increase in persistence and actual academic outcomes for the employee? So how many people are actually completing the programs? How much are they doing better than the baseline? The second is we look at mobility patterns, so both lateral mobility and the ability to move into jobs that are more future of work resilient, as well as jobs that allow them to actually earn more wages. And then the last thing we look at is just an increase in overall confidence in your ability to do your job either now or some future job that you aspire to do.
Bijal, so interesting and so good to have you on the program today. Thanks for joining us.
Yeah, thank you for having me. And sorry, my voice a little raspy. I just returned from Paris cheering on Team USA.
That's a good reason. Bijal. Thank you again.
Have a great day. Bye.
And coming up, our chart of the day when asking for a trend returns.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalyst.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Procter & Gamble, one of the biggest names in U.S. consumer goods, is seeing organic sales growth decline quarter by quarter. Is this an example of a larger consumer trend? Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Well, a lot of the economists and macro strategists that we speak to and whose notes we read, they look not just at the economic data, but they look at companies' reports. They listen to company conference calls to try to figure out what's going on in the economy. One of those folks is Connor Sen. He's the founder at Peachtree Creek Investments, and he tweeted this chart today, and he said, this earnings season has done way more to convince me of the current overall disinflationary trend than any economic data we've gotten this year. And Procter & Gamble is a consumer goods giant, of course, with a vast swath of different types of goods that touch different parts of U.S. life, right? And people spend money on. And so he points out that you've got this slowing organic sales growth. Last quarter, organic sales growth at just 2%, and that was the slowest in 6 years, and it was less than 3.4% estimated. Part of this has to do with lower prices that P&G is charging, which speaks to that disinflationary trend. We also earlier today heard from CEO John Mueller of P&G, and he talked about some of the cross currents affecting the company.
I don't doubt that some shoppers are more cautious. That would make sense. But if we look at a couple things, a couple data points that we have access to, one is the the volume share of private label, which is kind of a proxy for trade down in our categories, it's really unchanged versus both pre-pandemic periods and the last couple of quarters.
So interesting there that he's not seeing the trade down, but clearly the pricing trend is in favor of that disinflation narrative, Josh.
Yeah, I thought that was interesting, those comments about the shoppers. You know, we're always looking for those reads in the consumer, and how he said, Julie, there, I guess his point being some shoppers have been more cautious, but he was trying to make some distinctions there.
Yeah, then not everyone has been. I mean, the read-through is not just from only P&G, by the way. Kimberly-Clark recently came out with disappointing numbers too, another big company in that consumer goods space. I was, by the way, looking at the broader sales numbers, not necessarily organic sales growth, but just overall revenue, at least as of last Friday when FactSet came out with its latest earnings insight, the blended revenue growth rate for the second quarter was 5%. Now, as we know, we're hearing from a lot of companies this week, so we'll have to check back in on Friday and see how that number is looking.
All right, thank you, Julie. Now taking a look at some after-hours movers. Shares of Match Group jumping after the company reported a smaller than expected decline in paying users for Tinder. Company also posting better than expected revenue for the second quarter. Match has come under pressure from activist investors to reverse subscriber losses that have persisted for nearly 2 years. Also checking shares of Arista Networks edging higher after reporting better than expected second quarter earnings. Cloud company also issuing third quarter revenue guidance above estimates. And Live Nation reporting a 7% increase in revenue for the second quarter. However, earnings per share coming in below Wall Street expectations. Live Nation reporting $1.03 in earnings per share compared to the $1.06 the street had expected. That is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.